very happy to be talking with Stig Brodersen, who is the host of one of the top podcasts on iTunes. In fact, the number one podcast in the stock investing category on iTunes. The show is called The Investors Podcast. Stig, how you doing today?
I'm great, Doug. Thanks for inviting me.
So you talk a lot about stock investing. In fact, you often talk about stock investing 101, which I think a lot of people sort of overlook. They think, oh, well, I invest in stocks, but they don't get really how complicated it is. Is it in fact complicated, do you think, for people to make money investing in stocks?
No, I don't think it's complicated, but it's definitely very time-consuming. And I think that's probably one of the problems that we are facing as investors because, hey, we're all busy, right? And how much research do we actually really need to put into our stock research? And I think that the answer to that really surprises a lot of people.
Mm-hmm. And so what is the answer? How much research do you have to put in?
I'm glad you asked. Think about it like this first. Think about how long it takes for you to save enough money to start investing in stocks in the first place. And then think about, well, how much time do you actually spend finding a stock? So for most people, whenever they find a stock, they would say, I go to Starbucks every day. I really like the coffee. I will go buy Starbucks stock. And, that might seem like a reasonable approach for most people. And I definitely suggest that you actually do invest in goods and services that you like. But think about it like this. Say that you would be buying a house. Well, buying a house, you would probably like to know how many square feet, you want to know how many rooms, you would like to know the location, you would know a lot of different things. But whenever it comes to stock investing, it seems to be like, well, we don't need to know all the details. I think the stock price will go up. It's really important to separate the two because the key question is, how much is it worth? So, Doug, you probably wouldn't buy your home if it was 10 times expensive as it really were. No, because you're thinking about the valuation. And it's the same with stocks.
Well, the problem with thinking about valuation, in fact, I'm glad you bring up this very example because I'm dealing with it now. My siblings and I and my mother are dealing with selling the house which my mother owned my parents owned for about 50 years. And we met with a few agents, and interestingly, all of the agents gave a certain price they said the house was worth, and my siblings and I, we all thought it was worth about 20% more because we're laughing because we sort of think that's what we wanted it to be worth, and we said, a house especially, and we can talk about stocks in a minute, how does anyone know what the intrinsic value is of a house? It's a property, but you have to look into things like the school district and the neighbors. There's so many unknowns and so many moving parts. How could you make a decision about something that's only one thing that you own, let alone trying to understand what the value is of some traded stock?
Doug, I'm really happy you brought us this example about your own home. That is actually the most difficult thing to value for anyone, especially if you live in the home. So let me give you some stats here. And this was done after the crash in the US after 2009. And they asked how many people actually saw real estate prices overall in the States go down. And it was about 80%. Now, then when they got the question, do you think your home has decreased in price when almost the entire United States has decreased? You know what they said?
I see where this is going. Yeah, go ahead.
Yes, two-thirds of people replying to this said, well, at least their home kept its value. It might even have gone up.
Wow.
It's just, and there's so much emotional attachment. I would say, for your home, you grew up there, you have a lot of positive emotions. That's the best home in the world. And why can't we all see that? Why are we not willing to pay 20% more for that? The problem is, it's unfortunately your memories.
So it's not,
and it also tells.
I want to challenge that. I'm not sure it's my memories. I really know what the house is worth, and I believe, and this is where you can correct me, I believe that the agents are just anxious to do a sale, so they're willing to give it a price that's 20% less in order to make it go quickly, and then they can, put another notch in their lipstick case and say, and yet another house was sold.
Yeah, and I definitely think there is something to it. If you look at, in general, if people have an interest of selling something, typically by commission, they would typically say a lower price because the turnover, the time it takes to turn over a home is actually very expensive for the agent. But if you actually would like a really, really good answer to how much your home is worth, you should go ask your neighbors. Studies actually show that the neighbors in general are really good at valuing your home because they're a lot more objective about it, and they also know a lot more about the neighborhood.
Interesting. We're talking with Stig Brodersen, who is, in fact, very interesting. You can hear him on the Investors Podcast, which is rated number 1 in the stock investing categories on iTunes. So interesting, Stig, you're saying to ask your neighbors. So let's relate that, for example, to the stock market, where you're going to ask people who may not have an interest in a particular stock. For example, stock analysts. I'm not talking about stock analysts who would have an interest. Maybe they work for an investment bank, and so therefore they might give a company a very high rating in order to, on the other side of the table, win the investment banking business. But a stock analyst who maybe is an independent or an independent money manager or fund manager whose only goal is to make money for himself and his clients, because let's say he earns a percentage of the profits or a percentage of the value of the portfolio, why is there a problem, or is there a problem asking someone like that to help you to value a stock and figure out when it's trading below its true value so you could buy it?
Well, there doesn't have to be a problem. Very often, though, there is a problem because it's very difficult to make those interests align of the advisor and the client. Depending on how you're compensated, most advisors would be compensated, as you suggest, Doug, as a percentage, which means that the advisor would also have an incentive to pick very volatile stock for the sake of being volatile, because since they're getting a cut of how much it would go up, well, why not take a stock that fluctuates a lot? That's something that we see very, very often. And very often the client would have to pay the downside, but have to share the upside.
So that's maybe referring to a hedge fund. Hedge funds will often take a percentage of the profits, and they might even have a high watermark, which means that until they achieve that level again, they don't get a percentage of the profits. Let's talk about, for example, a mutual fund or a managed account where the money manager is simply getting a percentage of the value of the portfolio. So the only way for the managers to increase their income is to increase the size of their portfolio, the client's portfolio, and that's a disincentive for them to buy extra volatile stocks, because if they crush the client, then their income gets crushed and the client leaves.
Yeah, I'm not sure I agree with that, and I'm really happy we're having this discussion because we learn the most whenever we have disagreements. I can definitely see your argument. Yes, there would be a lot of reasons for them not to pick volatile stocks, and it is true. Very often they would take, very stable stocks, and there's this old saying on Wall Street: you can never get fired by picking IBM. But what happens for a lot of these big mutual funds is that they spend a lot of the money that the clients have on marketing, because they are compensated on their performance, but actually 2/3 on average of the revenue that they're achieving, that's from the expense ratio. That is from the fees they're charging for the money they're managing. So that's also why you see a lot of these funds are very expensive and all the money is spent on marketing.
Okay, so let's go back to what you said before. You were saying ask your neighbors what the value of your house might be, and then I tried to turn that around to a question of, so who should you ask about the value of a stock? So who should you ask about the value of a stock?
Well, I think the easiest thing for me, or the simplest thing for me, would to say you need to calculate it yourself. Or you need to find a person who you really trust and who has the same investment strategy like you. At the end of the day, the value of a business is how much money it generates. I know I make it sound simple, that's basically just it. So let me just give you a quick rule of thumb. On average, in the US, a stock would be trading somewhere around 15 to 17 times earnings. So on average, you'll be spending $15 to $17 for $1 of earnings, or what translates to around 6.6% in return.
So explain that a little bit further. Let's go into this. What you off the cuff, you said 15 to 17 times earnings is a normal PE, which is a little bit below, I think, what the S&P 500 is for now, but I'm not sure that's the right index to look at in any case. But why is that the normal? Why shouldn't it be 5 times earnings or 25 times earnings?
Yeah, it's a great question. And if you ask the academics, they would say, well, that is how much risk, or that is the return that investors will require for the amount of risk that they're taking on by investing in that asset class. But we can more or less see that the GDP growth for a country, something like, for instance, like United States, it follows the stock market, and then there is what we call a risk premium by investing in stocks.
Mm-hmm. So what you're saying is that people are willing to pay more than a risk-free asset in order to try to make more money, let's say compared to bank deposits or treasury bonds.
Yes, that's correct, because it's perceived to be a higher risk. Also because, as we talked about, stocks would be more volatile and people could lose their money a lot faster.
Mm-hmm. And you end up also with the possibility of a herd mentality, meaning if someone's willing to pay 14 times earnings for a stock, and then he says, well, maybe it looks pretty good, I'll pay 15 or 16 or 17 times earning. all of a sudden he's paying a lot more for that stock than when it was at 14 times earnings. And I think the problem is, and it goes back all the way to the beginning of what we were saying, is how people make decisions emotionally, like I was based on the house that we're looking to sell. It feels to me like maybe it's worth more, but that's not what the true market value is. I guess that's where people have to really be concerned.
Yeah, it's a great point. And you see, really hyped stocks like Amazon and Tesla. I mean, more or less they're not making any kind of money. But the reason why people are willing to pay a lot of money for the stock is that they expect growth. Now, I'm not here to say that Amazon would be a bad stock or Tesla would be a bad stock, but the companies needs to grow a lot and they need to make a lot of money before it can justify the valuation. And that's why, just like a really quick rule of thumb, if you need to invest in stocks, if you would like to value stocks, look at how much money that they're making and don't pay more than 10 or 12 times the earnings.
Interesting. All right, Stig, I think that's some very good advice you've given us and some real insight about how to look at stocks. Unfortunately, we are just about out of time. So tell me in the last few seconds, how can people follow you and follow your work?
They can tune in to theinvestorspodcast.com. We study billionaires and we study the financial markets. So please check it out.
Okay, we'll put a link to that at today's show notes. Thanks very much, Stig Brodersen.
Thank you, Doug.
You've been listening to the Goldstein on Gelt show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.